Hey guys, it's Zach here and welcome to my channel. So what's been happening in the last few weeks, as everyone would know, is if you go through any type of news right now, everything you're going to see is related to GameStop, Robinhood, and just what's going on with that whole situation. So what I thought I would do is I thought I would make a video just going over everything that's happened with GameStop, why it's happened, and what's going to happen in the future, and what's going to be the future implications of this. So GameStop is a publicly listed company on the New York Stock Exchange, and it trades under the name GME. What it is a brick and mortar company which sells video games and whatnot. If you're living in Australia, you might know of EB Games. This is actually a subsidiary of GameStop. So it's exactly the same thing. I'm sure you guys in the UK have an exact same version of it as well. So due to the impact of the pandemic that's been happening around the world, they have been significantly impacted financially. What's happened is their revenue has gone down by over 30% in the last year. Meanwhile, they've had to close 11% of their worldwide stores in order for them to cut costs and to keep their revenue, keep on going, for them to keep on turning that money machine. However, despite all this, GameStop has actually seen a 1,630% increase in its stock price since the 1st of January. So what we're going to do is we're going to talk about why this has happened. So this has all happened because of one thing. Reddit. So what's happened is a subgroup of Reddit called Wall Street Bets have decided to try and manipulate the system, and they have pretty much wanted to give the middle finger to all those people on Wall Street, all those hedge funds. And how they've done this is they've given this video a massive like and hitting that subscribe button. You know, it really helped me guys, help me out guys, you know. It would mean a hell of a lot to me. But actually why Reddit did this is because GameStop has a really high short interest. So what this means is a lot of people in, say, anything like hedge funds or investment banks are actually shorting this stock. So when you really want to talk about what is shorting, shorting means you are betting against a company. So you are betting that the company is going to go down in its stock price. So the way that an investment bank or anyone shorts a stock is that you borrow a stock at a higher price, and then later on you sell that stock at a lower price, and what you do is you profit the difference. So it's the exact same way to saying if I borrow a car off a mate and then I sell it, right? I sell it at say 10 grand, and then 5 months later my mate comes back and says, hey, I want my car. So then I go and buy that car back for 7 grand. I'm hoping to buy it back at a lower price, and then what happens is I profit that 3 grand difference between the two. The exact same thing happens with shorting. So as the stock goes down, what's going to happen is they're going to make more and more money, as there's going to be a bigger difference between the two stock prices. This was kind of a commonly thought thing that's going to happen with GameStop because of how the brick and mortar scene is right now. You know, brick and mortar stores are kind of going out of business and whatnot. So it was expected that GameStop, which is a brick and mortar operating business, is going to keep on going down over the next few months because of the pandemic, and just because of how the world is turning, how it's all turning online. And due to this, there was a massive demand of people wanting to short this stock. So overall, there was a hell of a lot of people in investment banks and the hedge funds that were trying to short this stock. So the users on Wall Street Bets, what they did is they orchestrated the plan for everyone to buy these shares. What this does is this creates an artificial demand for the actual stock, and it's going to rise the price. And what this is going to do is this is not going to allow those people who are shorting the stocks to borrow them and then to sell them back at a lower price later on. So the result of this artificial demand, while the supply remains the same, is that your price is going to increase a hell of a lot. So what's happened is that the price of GameStop has actually increased by 800% over 5 days. So now as the price keeps on increases, what the hedge funds realize is that the stock is moving away from them. So what's happened is they are losing money because they're having to pay premiums on their shorts. So then what's going to happen is they are going to have to buy back their stocks. So when you borrow a stock in order to short it, the only way to get rid of that short is to buy stocks. So what's happened is the people from Reddit have said, no, you aren't going to buy back these stocks. And if you are, you're going to have to pay an exorbitant amount in order to buy them back and to reduce your shorting position. So what's happened is it was at $4, so they've shorted it at that point there. And then 3 weeks later, it's at $340. No, what they're saying is you're going to have to pay this amount right now on every single one in order for you to stop your shorted position. Either you can do that, or you can keep on paying your premiums, which would be a hell of a lot. And what this has done is have made that a lot of these hedge funds and investment banks illiquid. So what's going to happen is a hedge fund really needs to be liquid. So to do this, they have to raise capital. However, the rates on this capital is going to be really unattractive, and a hell of a lot of people aren't going to want to bring the capital in because it's going to cost them a hell of a lot more money. So this is kind of where it gets really interesting, because the majority shareholder of Citadel, which is kind of a trading company in America, that's kind of a basic way of understanding it. They kind of allow you to go and buy stocks through them instead of having to go through the New York Stock Exchange. And what you do is you get a reduced price and having to do that. So what Citadel have done is they have participated in a buyout of one of the investment banks. And what they have done is they've put an emergency cash flow fund of $2.75 billion. And so what they've done is it's actually really weird. So what they've done two things. So they're profiting from the amount of money that's being made from people buying the stock, because they're getting a certain percentage share of the amount of people who are buying per stock, because it goes through them, especially going through something like Robinhood. Robinhood is their main partner. So they get every single share that's bought through Robinhood, they make, say, 0.5 cents per share. Not even that. So like but if they do 20,000, 100,000 per day, this comes up to be a hell of a lot of money. Like last year, they made over $6 billion alone. So they're making money through that one way. And what they're doing is they're making money a second way through these really attractive, unattractive rates they're charging these investment banks to have. So they're getting the $2.75 billion. What's happened is they're paying a hell of a lot of interest in order on this money, and they're getting a hell of a lot back. So they're paying two things. So they're getting money in through people buying the stock, and then they're also having propped up one company which is in a massive shorting position against this stock. So the implication of all this could be massive when you think about it, how much from the market. So first off, there might be implications for Robinhood and Citadel, because I know stopping trading like this might be infringing on rights and stuff like that, and it could open them to litigation. The second thing is that hedge funds now know this could happen. This has never happened before. There's never been a mass kind of way of thinking like this, which is pretty much screw the hedge funds. We're going to make you pay this much in order and we're going to screw you over. That's going to happen. And at the end of the day, there's no way that this can never happen again. Like, this can always happen again. This can be a different stock, and it can happen next week, this can happen tomorrow, this could happen in a year. This can always happen again, and it's kind of a scary thing for, say, something like a hedge fund, because they never know what's going to happen. They may have to do this all over again. However, saying this, these stocks will always go back down to their original pricing, because something like GameStop is now ridiculously overpriced. And what we're seeing is that it's gone down 30% yesterday. It's going to keep on going down until eventually it gets back to its normal position. It's going to get shorted again, and they're going to make their money all over again. Eventually it just comes in a massive circle, but it is pretty funny at the end of the day, and it's a massive thing that's happening against hedge funds and Wall Street, because there's a big massive culture that hedge funds, Wall Street, they're the big men. They think they're amazing. Everything's gonna happen for them. However, right now they've kind of been taken back a peg from just random people on Reddit. So if anyone really enjoys, the shorting stuff, they really enjoy the financial side of really understanding how this all works, I would really recommend watching the movie The Big Short. What this is basically they've shorted against the housing market during the great financial crisis. They predicted it. And then because they've shorted against the housing market, they've made a hell of a lot of money. I would really recommend anyone to watch The Big Short. It has Brad Pitt in it, has some really good actors in it. I would really recommend watching it. But that's going to be all for me today, guys. I hope you guys all have a great day, and I will see you next time.